I love when I come across these surprise listings on the walks like this. I wasn't intending on starting the video in front of this house, but I happened to see it right by where I parked. So let's take a look at it. This house they actually bought for $2.25 million and then quickly just turned it around, listed it for sale for $2.48 million, and now they've already lowered the price to $2.15. So they're already asking less money for this house than what they paid for it not that long ago. And I don't have all the details in front of me, so I'll do a little voiceover here with the property taxes and all that.
Now, I'm not exactly sure what's going on here. I think it's very suspicious to buy a house and then literally a year later you're already selling it and for less than what you paid for it. First I thought it was a flip, but flippers don't typically do that unless they are desperate for cash. So it is possible, but just doesn't seem like my first impression. But anyhow, maybe the reason they're selling this house is because of the property taxes. The property tax bill as of 2022 is $20,446, and I don't know if this house is rented or if it's empty, but either way, that is a big pill to swallow on top of all the regular maintenance for a house like this.
And one thing it seems like that I can tell from the comments that you guys make on my videos is that I'm pretty well known for at this point for covering abstract real estate issues that a lot of other channels don't cover, which I enjoy doing because I think it's important for people to know more. And you know, it's fascinating to learn all these different aspects of real estate. And the one that we're going to cover today is mortgages. And the reason why this is kind of funny is because I've seen so many people joke about this in the comments in the past about, you know, mortgage means basically you're paying until you're dead. And in French, the word actually means death pledge. And the idea here from the word mortgage is that when you pass away, your mortgage doesn't suddenly disappear. It's not like, oh, okay, they're gone, you don't owe us the money anymore. Not so fast, which is why it's called a death pledge. Mortgage debt outlives you if you still have a mortgage when you die. And basically how this works is, say you pass away and you still have debt owed on the property, well, that debt either needs to be paid by your estate when you die, or it needs to be paid by a co-borrower. If you have someone else on the lien that still is alive, they take over the payments and continue paying for the mortgage. And if none of that is possible, well, then the lender's going to foreclose on you, just like as if you were still alive and you stop paying your bills. Now, the reason why this is important to talk about is because besides what happens if you die and you still have a mortgage, well, what happens if you inherit a house that still has a mortgage? You know, what's going to happen? I'm sure a lot of people are going to face a similar situation at some point down the road, whether they inherit a home from their parents or grandparents or some other family member, and there's a good chance that there might still be a mortgage on the property. Well, one of the first things that you have to do is you have to let the mortgage servicer know that the person who had the mortgage has passed away. And some states even have laws where you need to do this within the first 30 days after death. And I know it sucks to start tackling these major financial issues so shortly after a loved one passed away. I've seen my family deal with this exact thing numerous times, and it sucks, guys. It really sucks because, you know, money is the last thing that people are thinking about when something like this happens. But yet, if you don't handle these things right away, you know, you could be at risk of losing something like a major asset like the house, for example. So basically, if you inherit a house that has a mortgage, you have a few options. One, you can continue paying the payments and keep the house. Number two is you can try to assume the mortgage if the lender will let you, and, you know, place the property, everything like that, under your name. Or you can let the lender foreclose, and that third option is horrible, guys. Never do this. If you ever inherit a property, don't let the bank foreclose on it. Maybe with the one caveat being that, you know, if the house is worth 200 grand and they owe 500,000 on it, well, maybe in that case, it makes sense to let them have it, you know. But in all other circumstances, I think it's a terrible idea to let the bank foreclose on a property that you inherited, because you could be walking away from a lot of cash on the table. In many instances, especially with how much home prices have gone up, you could sell the home, pay off the mortgage, and pocket the difference of whatever equity was left in the home. But when people died broke and they had, you know, a ton of home equity loans or home equity lines of credit and credit card debt and all of this, then in some cases like that, there might actually be no equity left in the home. That would be unfortunate and could be another situation where you might want to let it go into foreclosure. But this is not legal advice, guys. These are just loose opinions based on what if scenarios. Of course, you're going to want to hire an estate attorney or a probate attorney, somebody that can give you real solid professional advice if you ever find yourself in this situation. And the other thing is, things can get even more complicated if, say, you have 3 siblings, you know, you're one of 3 siblings and your parents pass away and they give you all 1/3 of the house. That can make things even more complicated, and 9 times out of 10, usually the best thing to do for most people is to just sell the house and take the proceeds and split it 3 ways, because chances are all 3 of you are not going to agree on what to do with the house. You know, someone might want to live in the house, another one might want to turn it into an investment property, and someone else might want to sell it. And when you have all conflicting interests like that, really the only viable option is to just sell the house, take the profits, and move on. Now, the one benefit of actually inheriting a mortgaged home today is if the mortgage that you're inheriting has a low interest rate and you can afford the payments, it could be a good win for you, and you'll be able to take over the payments of that property fairly easily without having to get a new loan. But usually, if you want to turn it into an investment property, a lot of times you'll have to get a new mortgage, and under today's lending standards, it might turn a property that would be profitable under the current mortgage unprofitable if you had to get a new one for investment. Now, if you want to assume the mortgage, you can do it directly with the lender, but really the best thing to do is to hire a lawyer, because they'll be able to help you get the most favorable terms and make the transition a little bit smoother. Now, say for example, if you're someone that may actually pass away with a mortgage and you're planning on passing that property down to an heir, a couple of things that you can do in order to prepare for this and actually, you know, make sure that your heirs are not going to have a hard time is you can either, one, have an estate plan. And the good thing about having the estate plan is it'll usually minimize the amount of taxes that your heirs are going to have to pay when they inherit the property. And the other thing that you can do is you can have mortgage protection insurance, which is a type of insurance, which is basically if you die and you still owe the money on the mortgage and your property is supposed to be inherited by one of your heirs, then the mortgage protection insurance pays off your loan balance when you die, which makes it very simple for your heirs. They can inherit a fully paid off property and not have any worries on their end. So having a mortgage actually goes beyond till death do us part, because even death doesn't separate you from the mortgage. And speaking of mortgages, I recently received this random email from Fifth Third Bank advertising physician loans. Now, I don't know why they sent this to me. I don't have a college degree. I'm definitely not a physician, but for some reason I received this. Maybe they think I have doctor clients as a real estate agent or something. But anyways, let's take a look at some of the terms of this loan. To me, when I saw this email, right away I thought predatory lending, because yeah, doctors make a lot of money and they can afford to pay off a lot of debt. But first of all, let's think about how much doctors have in student loan debt most of the time when they graduate. So they already have this huge mountain of debt before they even buy a home, right? And then you have programs like this that try to saddle you with even more debt. So even though you might make a lot of money as a physician, you could be in debt for the next 30 or 40 years just trying to pay off your student loans and your mortgage, and you know, might never be debt free, because the way that people live, you know, they have lifestyle inflation. You went to school all this time and you want to take advantage of all of your hard-earned effort and have nice things, you know, have the nice house, have the nice car, and spend money on the credit cards, have the wife and kids, and next thing you know, you're just drowning in a sea of debt that you're likely to never get out of. So let's take a look at this. It says, ideal for licensed interns, residents, or fellows who are scheduled to complete medical residency and start working within 90 days of the purchase of a new home. So you don't even have to be working yet to qualify for this. Also available for licensed interns, residents, or fellows who have started working for a hospital or physicians group within the last 12 months. Eligible customers may borrow up to $1 million with no down payment required. You see, that's the other hook to this. No down payment required. Of course not. How could you require a down payment? I just graduated with 300 grand of student loan debt. How could I have a down payment? They have fixed and adjustable rate mortgages available for your convenience. No private mortgage insurance is required. At least they got a lucky win on that one. They have refinancing options available in case you already own a home. And if you're already a physician, they have these terms. Ideal for licensed non-residents, interns who are out of residency for 12 months. Also available for licensed non-resident interns who have been self-employed as a medical doctor or dentist for at least 2 years. Eligible customers may borrow up to $1 million with no down payment required, or up to $2 million with a 10% down payment when purchasing a home. They also have fixed and adjustable rate mortgages available, no private mortgage insurance. So what a deal, guys. You can get yourself into another $1 million, maybe even $2 million worth of debt, even though you're just getting started in your career. Here's the lesson that I take away from this. Just because you're a doctor, just because you have a high salary, doesn't mean you should max this out and take the full $1 million mortgage that places like this might be offering you. Is it as tempting as it might sound? This is debt that you might never get out of. And having an extra $1 million in debt on top of your student loan payments sounds like a pretty horrible idea. Now, if you use this program to buy a modest home of maybe like $300,000 somewhere, then maybe it would be okay. And these loan terms are more favorable for a physician, especially if you can get the 0% down. I'm a big proponent, guys, of putting down a large down payment every time you buy a piece of property. And the main reason for that is you have equity right up front. It protects you from these big looming real estate downturns that we're facing right now. So when you have that protection, you can actually survive one of these downturns without losing all of your equity in your home.
You can't see me, but every time I see a listing like this, I'm just sitting here shaking my head while I'm talking to you. This house has been for rent since June 2022. Original asking price, $25,000 a month. Several price cuts later, now they're asking $16,000 a month, and it's still empty. It's been almost a year. What's the strategy here? I don't know. I guess throw money away on the house instead of give it to the IRS. That's the only thing I can think of. Property tax bill. As of 2022, they are now up to $21,512 a year, which is also a pretty large bill for an empty house.
Because the thing is, imagine you put this 0% down, which is nothing, on your new property, and let's say you go through the halfway mark. You get a $500,000 home. Well, in a lot of cases, the $500,000 homes today were only worth like $350,000, maybe a couple years ago. And if this downturn goes bad and things really happen like it did in 2008, and say even your home value drops to $400,000, you're $100,000 underwater on that home within just a year or two of buying it because you have no equity, okay? The reason why this is a massive problem when you're underwater on your mortgage, and I've explained this before, is because if you ever want to sell that property, you're not going to be able to without, number one, short selling it, which is really not good for you, or number two, if you sell it, you have to come to the closing table with money, because let's look at it. You owe 500 grand on this house, but you're only able to sell it for 4. So you're going to come to the closing table owing the $100,000 that the property went down in value by, okay? You're going to owe that. You're going to owe real estate commissions, which is going to be at least another 15 grand on a property like that. And then you're going to owe all the closing costs, which is roughly 2% of the price of the property. So you're going to be coming to the closing table with an extra 150 grand, probably at minimum, just to get out of this house. And this is the reason why you never want to go underwater on your home. So as tempting as these 0% down loans can sound, I would not do it. I know VA has that option and USDA loans have this option too, to have 0% down, but I don't know, guys, I'm just not a big fan. You're pretty much setting yourself up for failure if you ever need to sell that property within the next 10 to 15 years even, unless you get extremely lucky and the property just skyrockets in value to compensate for that 0% down. But I think it's pretty safe to say that at this point in time, most of those gains have already been realized, and they're already being lost in many cases in different places across the country. Just think about if you took one of these 0% down loans and you were a home buyer in Austin, Texas, where home prices are down 18% since the peak of June. You put 0% down, guys. So now that's an 18% loss on your property. And ironically enough, those numbers put you pretty much within the range of the example I just gave. If you buy a $500,000 home in Austin, Texas, that puts you $90,000 underwater on that home, okay? So just go ask people that had to recently experience that and see how they feel about being that far underwater on their homes. I know not everybody puts 0% down, but even the average home buyer, they usually don't put more than 10% down when they're buying a house. So in many cases, a lot of those people are still going to be underwater. And as if all of this isn't bad enough when it comes to getting into debt with your house, okay? I just saw this ad today on Instagram, and I had to look this up and go to their website and show you guys this. I mean, this might have existed for a while. I never heard of it until today. There's this new credit card called Aven, and what it is it's a credit card that's directly linked to your home equity, guys. Normally, you have a credit card and you charge it, you go into debt, whatever, you owe the credit card company money, but it's not attached to anything besides that credit card. So if you can't pay, the account goes to collections and they'll end up closing your account, and they might try to chase you down in the collections. It'll ruin your credit and have some negative impacts on you. But one thing that they're not gonna do is they're not gonna take your house away. But with this new Aven credit card, that's exactly what would happen if you were to do something like this. And let's take a look at the terms of this credit card, okay? So it works just like a HELOC, a home equity line of credit, and they have a variable interest rate, just like HELOCs have, anywhere between 8% to 15%, pretty much. And they give you up to a $250,000 limit, right? And they'll give you an approval in as quickly as 15 minutes. They don't charge you an origination fee, they don't charge an annual fee, no appraisal fee, no notary fee, no prepayment penalty, no escrow fee. So imagine how tempting something like this would be for somebody that, you know, is dying to spend their home equity. And what easier way to do it than having a credit card directly linked to how much your house is worth. Now, just like every financial tool, I think something like this could be useful for the right person who is financially responsible with their money and always pays their bills on time and is not going to see their house get foreclosed over this. But the reality is, this type of thing is usually targeted at people who can't pay their bills and they're looking for extra cash, and they probably already have credit card debt, and they get this type of offer in the mail. Oh, I'm already maxed out on my regular credit cards. Now I can go out and spend all of my home equity too before I completely run out of money. This is crazy, guys. It's absolutely crazy that things like this exist and people are utilizing these things because it just spells trouble, if you ask me. And the funny thing is, it seems like there's no shortage of ways that these banks and corporations come up with of different ways to just suck you dry and take all of your money, guys. I mean, the plan for all these people is to riddle you with debt to the point where you can't pay and you have to give up your most prized possession, which is your home, okay? And where do you go next? Where do you go next when your credit's ruined and you've already screwed everybody over, all your creditors? What do you do now? Well, landlord's not going to take you. They're not going to want to rent to you. You just went through a foreclosure and you can't pay your bills on time. You have all this credit card debt. Not going to be able to rent anywhere. Going to end up homeless on the streets. If you ever see something like this, be extremely careful. You know, do whatever you want. Like I told you guys, none of this is financial advice. It's all just a heads up on what's out there and what's happening, but it's up to you to make your own decisions. If you enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video, and if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.